How do FHA, FHA, and conventional loans impact closing costs? Imagine walking into a home closing and seeing a big list of costs. Some are unavoidable, and some can be negotiated. Knowing how different loans affect these costs can save you money. FHA loans, or Federal Housing Administration loans, usually come with closing costs between 2 and 6% of the loan amount. One big cost is the upfront mortgage insurance premium, which is 1.75% of the loan amount and paid at closing. This insurance protects the lender if you default. There is also an annual mortgage insurance premium of about 0.55% of the loan amount, paid monthly. These costs make FHA loans a bit more expensive over time. FHA loans requiring a minimum down payment of 3.5%, which is due at closing. But sometimes, sellers agree to cover some closing costs, helping you pay less out of pocket. VA loans, or Veterans Affairs loans, tend to have lower closing costs, usually from 1 to 6% of the loan amount. One advantage is that veterans can ask sellers to pay up to 4% of closing costs as concessions, which can cut your upfront expenses. VA loans do not requiring mortgage insurance, which saves money each month. Instead, there is a funding fee, which can be added to the loan or paid at closing. This fee varies but is generally around 1.45% of the loan amount for first-time users. VA loans often do not requiring a down payment at all, making them easier for many veterans and active service members. Conventional loans are similar to FHA loans in closing costs, usually between 2 and 6% of the loan amount. Unlike FHA loans, conventional loans do not have an upfront mortgage insurance premium. If your down payment is less than 20%, you will pay private mortgage insurance, or PMI, which is paid monthly. PMI costs depend on your credit score and how much you borrow compared to the home's value. Once you reach 20% equity in your home, PMI can be canceled, lowering your monthly costs. Conventional loans often requiring higher credit scores and larger down payments, but the ability to cancel PMI can save money long-term. For Asian American homebuyers, understanding these differences helps in planning your budget. FHA and VA loans are popular because they lower upfront costs and sometimes allow seller contributions. But it is wise to consider the long-term costs of mortgage insurance with FHA loans versus the potential to cancel PMI with conventional loans. In summary, FHA loans have higher upfront mortgage insurance costs but lower down payments. VA loans usually have lower closing costs and no mortgage insurance, with no down payment needed. Conventional loans have similar closing costs but may requiring PMI if your down payment is small, though PMI can be canceled once you build enough equity. Always look at your financial situation, credit score, and home price to choose the best option. Negotiating with sellers and understanding local market conditions can also help reduce your closing costs.